So you've saved up a chunk of cash and you're ready to invest, but you don't know where to start. In this episode, we're going to go step by step on how we would invest $5,000. Welcome to Get Started Investing, a podcast where we cover everything that you need to know to kick off your investing journey. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We are answering one of the common questions we get here at Equity Mates, which is, how do I start?
Yes.
How would I invest if I've got some money saved up and I don't know what to do?
Yes.
So specifically, this question came in from Ellen.
Hey, Equity Mates. I am 25 and recently got a new job and a pay increase. I finally feel like my basic financial setup, including an emergency fund, is sorted. And now that I have some extra income, I've been saving it with the plan to invest. I'm close to $5,000 now and I'm ready to invest it, but I'm feeling a bit lost of what to actually do with it. Do I put it all into one ETF? Do I start a core and satellite approach and split it? What would you do? Thank you.
Okay.
Love it. Great question, Ellen. Thank you for the question. A reminder that if you want to ask a question, there will be a link in the show notes for you to leave a voice note. We would love to hear from you. So in today's episode, we are going to cover 2 ways to approach investing a lump sum. We're going to go step by step on how to decide where to invest and then where we would personally be putting $5,000 right now. Wow.
So you've got a lump sum. There's really 2 choices that you need to make. What to buy,
Yeah.
and then how you're going to buy it,
Yeah.
and or how regularly you're going to buy it.
Yeah.
Do you drop the $5,000 in day one, or do you spread it out over time?
Yes.
So let's start with the sexier choice, the more interesting one, the one why people have clicked and downloaded this episode. what you're going to buy, and I think you need to start with the less exciting part of it, which is defining your goals and your investment time horizon.
Yeah, okay. My goal is I want to be rich.
I want to be
What
rich.
do I want? What should I invest in?
How soon do you want to be rich?
Does it tomorrow?
Okay. And what does rich mean to you?
Very good question. Going deep here. Ability to not work.
Okay, so you want to turn $5,000 tomorrow into the ability to never work again.
Yeah, bad news. Wrong podcast.
The level of risk you need to take to try and make that happen. Yeah, different podcast.
Yes,
Yeah.
I'm not willing to take that risk. Let's just say I want to be rich, but I want to be rich in 40 years.
Okay. Great. So you're looking, you want to buy growth assets. The stock market makes sense, especially if you've got $5,000, because a lot of other growth assets, you're going to need more than $5,000 to buy them. 40 years is a realistic time horizon to start growing wealth.
Nice.
You'll probably need to top it up on the way if you want to,
Yes.
build some meaningful wealth. But I think for a lot of people, that's the starting point.
Yeah.
Maybe not 40 years. Maybe people are thinking 10, 20, 30 years.
Yeah.
But you want to grow that money. And so you've got choice in your life. So you've got freedom in your life. And so that means we need growth assets.
Yes.
So what are our options if we want to start the growth journey?
The first one is what we call an all-in-one ETF. These ETFs are designed to give you global exposure to the biggest companies in the world in one simple trade. And the reason that those are growth investments is because you're investing in companies that are going to continue to grow and going to continue to be market leaders over the next 10, 20, 30 years. And that's where you want your capital to be.
Yeah. So all-in-one ETF, that is certainly an option. What are some
examples?
Yeah.
So Vanguard's Diversified High Growth is one, VDHG. It gives you exposure to the US markets, Australia, Asia, Europe. You've also got BetaShares Diversified High Growth, DHHF, very similar exposure to multi markets around the world. So the reason we call them all-in-one is because unlike having to go out and buy multiple ETFs that give you exposure to different markets, these ETFs wrap it all up in one.
Yeah.
So pretty straightforward. We have actually done a deep dive on both of those ETFs in our ETF Explained series. So just have a look for VDHG or DHHF.
Yeah. So that's option 1. Option 2 that Ellen mentioned in her question was a core and satellite approach. For people who are unfamiliar with those terms, it's where your core of your portfolio is like is an index ETF, something that just takes the market's average return, and then the satellite, the smaller investments around it, you try and beat the market, maybe with other ETFs, maybe with active managers, maybe with individual stocks. So, you could do like, in this instance, like $4,000 into a core portfolio, $1,000 into your satellite. I would say, as a rule of thumb, thinking through your different options, $5,000 isn't a heap of money in the scheme of what you're trying to grow. I know for people who are early in their journey, especially early in their working lives, it can feel like a lot, and it's for a lot of people, it's the majority of your savings early on. But if you're trying to build like $1 million portfolio, it's not a heap in that context. And I think the important thing is you don't need to make a lot of investments with $5,000. I would be saying 1, maybe 2 max. Yeah. And that might be just the all-in-one ETF that you're speaking about, Bryce. It might be, just an Australian ETF and an American ETF, an ASX 200 and S&P 500.
What's the reason for that, though? Because I think sometimes you get to this point and all you hear is diversify. So I'm going to put 500 across 10 things, or 1,000 across 5. Why don't I spread it?
So a couple of reasons. First of all, you've got to remember, if we're talking ETFs, the products themselves are already diversified. Yeah. The ASX 200 is 200 companies. So that's an important starting point.
Yeah.
The second thing is transaction cost. So there are some brokers where they'll offer $0 brokerage, but the majority of brokers will have transaction costs attached. And so let's say it's $2 brokerage to buy an investment. If you're spreading across 10 investments, you're doing 10 times the transaction costs if you just had one investment. And then finally, and this kind of depends on your risk appetite and where you're wanting to invest, but diversification is great to protect wealth. It's often not the best way to grow wealth, because this is more for individual stocks. If you took that 5,000 and said, I have some great companies that I want to buy their specific stocks, your 10th idea is never going to be as good as your first idea. And as you're early in your journey and you're wanting to grow wealth, you really want to have the majority of your money in your best ideas, that you have the highest conviction that they're going to grow the most. And so you don't want to dilute your good ideas by chucking in some bad ideas in there or some not as good ideas for the sake of diversification. So for complexity, for transaction costs, for the not diluting your best ideas, you just want to keep it simple. I
agree. So we've spoken about the all-in-one ETF and the core and satellite approach. It sounds like, well, we both would be leaning, I think, with the $5,000 lump sum at the moment to be leaning towards the all-in-one, or at least if it's a core and satellite, maximum 2 positions at this stage.
Just don't do core and satellite now. Yeah. Just do core if you want to. Yeah. Or if you've got some stocks that you love or an active manager you love, just start with that. Yeah. But I think if you're uncertain and you're looking for a place to start, to be very specific, I would say a global ETF, an S&P 500 US ETF, or a NASDAQ 100 US ETF, or an ASX 200 ETF. Choose one. That's your starting point.
Yes.
Keep going from there.
So then the second part to Ellen's question was around how to deploy the cash. Do I want to be putting it all in at once, 5,000 bang, cross my fingers, hope that it goes well, or should I be dipping or allocating it over a period of time, what is called that sort of dollar cost average approach? So a couple of things to consider here. Where do you lie, Ren?
It's a funny one. There's 2 ways to answer this question. The academic research shows time and time again that in most places, in most markets, at most points in history, in most asset classes, the right answer is just lump sum.
Get it in.
Just get the money in the market as soon as possible and give it as much time to grow.
Yeah.
And there's books and there's plenty of stuff that you can read about that. So if you want to go deeper on that. So part of me thinks just get the money in. And that's, the classic time in the market beats timing the market. But the reason that I sort of hesitate as I say it, and there is a but, and it's the psychology of it. It's daunting to just drop all the money you've saved into the market at one time with the fear that the market could crash the next day.
Yeah.
And so I think for people who don't have that level of confidence and they're just bullish and they're just ready to go, dollar cost averaging is a really sensible way to start investing slowly, to let yourself get used to how the market moves, how investing works, to dip your toe in the water, so to say.
I would go one step further though and say that if you're going to take that approach and think that you're going to split the 5,000 over a number, make sure you automate that process, because to your point around the psychology of it, dropping 5,000 at once or 1,000 for every 5 times, every time you go to do that 1,000, you might think to yourself every time, the market might crash.
Yeah. Or my investments are down
It's
3% already.
Yeah, so
I don't know if I want to risk it.
I'm going to wait a bit. And so all of a sudden, you're just drawing out the process and you might end up putting yourself off entirely.
Yeah.
So I think if you are going to take that 5,000 and split it up, automate it and just say over 2 months, I'm going to put it in and that's it. And I'm happy with it.
But now let's get to brass tacks, Bryce. Let's just answer the question directly. I give you $5,000 as a bonus for all the good work you're doing here at Equity Mates.
Yeah.
How are you investing it?
How I am investing it is option 1. I am going to take the full 5,000 and I'm going to put it into an all-in-one ETF. And that ETF is going to be GHHF. Okay. It's going to be BetaShares Wealth Builder Diversified All Growth Geared ETF, which gives me global exposure to some of the biggest markets around the world, but also has a little bit of a rocket underneath it in terms of gearing. So we have done an episode on this as well on our ETF Explained. Make sure you go and check that out. But this for me is a portfolio that I'm not going to have to worry about for 10 years because the construction of it, it's giving me exposure globally. And as I said, it's got a little bit of leverage. So that's why I'm doing it. And I'm going to be investing the 5,000 all at once because Ellen has said in her question that she's been saving up to this moment. She has the foundations right, which tells me that she'll be able to, from this point in time, engage in an ongoing DCA investing strategy. So take the 5,000 and then Ellen set up some frequency where you're putting money into GHHF or whatever you choose on a regular basis. Pick a broker that does it for you automatically and let that build up to a meaningful position and a meaningful size. As Ren was talking about it, let it compound, let it build. Don't worry about buying too much for too many transaction costs, all that sort of stuff. Sit back and feel great. Because I think if you do that, Ellen, you'll find pretty quickly that in 25 years' time, you're going to have a pretty nice little nest egg.
Yeah.
What about you?
Well, look, I'm torn because I was going to give basically the same answer as you. I was going to maybe say GNDQ rather than
which is
GHHF, and that is a geared version of NDQ. And NDQ is an ETF that tracks the NASDAQ 100.
Yeah.
NASDAQ 100 it's an index of 100 US stocks that are listed on the NASDAQ stock exchange. They're weighted more towards the big technology names. So, that's the part of the market that is just ripping at the moment. At some point, the music might stop with the AI and semiconductors and all of that, but it doesn't feel like that's coming anytime soon. So if you were like, I want to see growth, that's where I'd be going. And to be honest, if someone gave me $5,000 today, I would either be doing that or I'd be buying an individual stock that I liked.
Yeah.
But if I was to put myself in Ellen's shoes and say, this is the start of a 30-year investment journey and I want to set the foundations for something that I can dollar cost average into every time I get paid from here until I have enough money to retire, I would maybe do the majority of the money, maybe 80% into an all-in-one ETF. VDHG or DHHF would be 2 names that I'm looking at, not geared, just big long-term ETFs. And then the remaining $1,000, so 20% of the remaining money, into something a little spicier like we've been speaking about. Nice. So maybe I'd go 80% VDHG, 20% GNDQ, and then every time I got paid, I would keep those percentages the same and dollar cost average into both of them.
Love it. Well, to that point, Ellen, if you invest the 5,000 and top up your portfolio by only $100 a fortnight, compounding it just 10%, which is about the average return for the market, in 25 years, you'll have just over $300,000 simply by just taking that market return So it's all ahead of you, Ellen. Great question. We appreciate you sending it in. And I hope we've been able to show that everyone in Ellen's position as well, how easy it is, I think, to get into the market and really build an investment strategy that doesn't take a lot of time, and also importantly doesn't take, you don't need a finance degree or a huge understanding of markets to get in there and start building a long-term portfolio. So we would love to continue to hear from the community. We love the questions that are coming in. Please, if you can send us a voice note, there will be a link in the show notes below to do that. Please do. And if you're loving these episodes, also, we would love to hear from you. If you can like the video, if you're watching on YouTube, or leave a rating and review in your podcast app, it really does help us get in front of new Equity Mates listeners.
And tell us how you would invest the $5,000, what products you'd be buying, what stocks you'd be buying, especially if you're on YouTube and you can just comment. Tell us what you'd be doing with it.
Yes. Yeah. Love to hear from you, and we'll pick it up next week.